Excited for tonight as Andy wraps up this mini-series on the wisdom in your wallet, and really just taking a look at what does the Bible have to say about wealth, about our finances, about how we're to steward those finances. And I love that he has blended together deep, rich, biblical truth with very practical, helpful tips and strategies. And so we're going to get even more practical tonight. Excited for that. Can you guys give it up for Andy as he comes up? Let me pray for you, Andy. Heavenly Father, thank you so much just for the hard work that Andy has put into preparing for this. Grateful for his willingness to do this for us, and just pray that you would bless him, and just pray that you would allow him to speak tonight what you've put on his heart, and Lord, that would be from your heart to us. So we just lift him up to you and ask that you would bless him this evening. In Jesus' name, amen.
All right, thanks, Sam. I'm impressed. You guys came back for week 3. That is impressive. Well done. All right. Well, for those of you who maybe weren't around for the first couple weeks, like Sam said, we've been at this for 3 weeks. Our first week, we did a biblical review, and I went through a number of key texts and then offered forth a proposed kind of Christian framework for thinking about money. So we did a lot of Bible study that day. Last week, we used that framework, and I gave you guys my 10 practical tips that I want to teach my kids about how to live a godly, wise, and healthy financial life. And then week 3 is today. So we're going to get really practical, as Sam said again, and talk about how to give so that the kingdom gets more and you waste less. We'll go through these quickly. It's week 3. You've heard this drill by now, but the goals of this whole series were to stay biblically grounded. Tonight we're going to talk a lot about giving, but if you go back and reflect on the last 3 weeks, it's clearly not been a 3-week series only about giving. We want to be practical. I'm going to be as much as I can relevant across life stages, and then tonight you're going to have to forgive me a little bit, right? So my goal is to make this as accessible as possible, but it's going to get a little technical tonight at times. So forgive me for that, and the main point is not, if you walk out of here and you're like, I didn't fully understand every calculation that he just talked about, that's okay. It's mostly to give you just a sense as to kind of different levers that are out there. Obligatory disclaimer, general perspective on what the Bible has to say about money, general financial education. This is not personal investment tax or legal advice, so make sure to seek a qualified professional for your own situation. Okay, let's get to the fun stuff. So just like the last 2 weeks, I want to start off by getting into groups of 3 to 4, and with those around you, 2 questions to talk about. As you think about giving, do you tend to be someone that pre-plans their giving, or do you tend to go more spontaneously? And then the second question I have is, when you do decide to give, which method do you tend to prefer to use? So how do you actually do it? And so while you do that, if you missed it, I do have a handout in the back that will kind of help you follow along tonight's discussion. So talk amongst yourself. If you don't have the handout, go grab it. And you got 5 minutes. All right, excellent. Okay, let's bring it back together. All right, so hopefully that was a helpful starting point. Glad I got the juices flowing. Would love to have you guys come back and think about those as we get towards the end. But let's jump into tonight's content. So, as I mentioned in the previous weeks, I proposed a 7-bucket framework for how we as Christians can think about money. So for those of you that weren't here, this is just a recap. So 7 buckets, it starts with earning faithfully. Most everything in the financial life is going to flow from that top line, that income. From there, we said the first thing we want to do is honor the Lord with our wealth and with the first fruits. So we're going to give generously, spend strategically, save aggressively, invest wisely, and all along the journey, we want to steward taxes and navigate uncertainty. So tonight, we're going to dive deep on those 2 that I have shaded. So giving generously and stewarding taxes. Last week, just to kind of bring us back, we looked at that framework, and I had 10 practical tips that we went through. I'm not going to redo them tonight. If you missed it, we have a handout with this that we gave out last week. If you shoot me an email, I'm happy to send it to you. But we recognize that of this list of 10, 9 of them, I would argue, are wise moves even for a non-Christian, right? They're just wise things to do. But there's one that stands out that if there's a non-Christian that I was talking with, I would probably say, this one might not resonate as much. And that is the tithing piece that we talked about. And last week what we focused on was there's 1,000 reasons not to tithe, or to maybe say, I'll get to that in the future. But my encouragement was start now. I like this question because sometimes you probably have done the same. I ask myself, how is my life different because I'm a Christian? And I think this is one of the clearest ways sometimes we can point to say, that is pretty distinctive. I mentioned last week that the average giving rate in the United States is something like 2%. So this idea of giving a tenth is quite countercultural. So Pastor Sean unfortunately had to head out, so I'm going to do something that no pastor in their right mind, sorry Pastor Eastman, would ever do, okay? But this is where my mind goes sometimes, and this question: how much more money would I potentially have if I didn't tithe? Okay, and we might think he was just talking about 10%, so maybe it's 10%. But as we talked about last week, right, there's a compounding effect, right? And so for those of you that were here last week, I kind of went back to my illustration of early Evelyn. So early Evelyn graduated college at 22, saved consistently till retirement at 67. And I just kind of reran the numbers and wondered what would her age 67 retirement wealth look like if she didn't tithe, and compared that to if she did tithe. And the number was 80%. So Evelyn would be 80% wealthier at retirement if she did not tithe. And that's going to be different for everybody depending on a lot of different circumstances. But, that gives you a sense as to how countercultural this idea is, right? 80% more wealth means you could spend 80% more every year and so forth, right? So again, this is not something that you typically would hear about in this church context, because remember, I did say start doing it. But this is not what you would do if your objective was just maximize the amount of money in my bank account, which I don't think as Christians our objective should be. But it's countercultural, and that's what we're called to, right? Okay, so let's get into it. This one's going to be fast. I'm going to spend most of our time tonight on how to give. But just quickly, I wanted to cover this thought of when to give. So Redeemer was kind enough to share with me 2025 numbers on their expenses throughout the year, as well as how the donations came in. And so I thought you guys might find this interesting. The gray bars here are each quarter what the expenses looked like, and the blue bars are when the donations came in. And you see the gray bars are pretty constant quarter over quarter, right? But you look at the blue bars, and there's this huge influx in Q4, right? A lot of last minute, I got to get my tax situation in order, right? We'll talk about that. And that's fine, right? Better to do it than to not do it. But my first kind of tactical encouragement for us on the when and the timing is don't forget that the church and any charity that you work with and that you contribute towards has expenses throughout the year, right? So, be mindful of that and try to give throughout the year. I think that could be a great help for whatever organizations that you're supporting. Okay, but we're going to spend the rest of our time tonight on how. So the first thing I have to do is I have to tell you a little bit more about me, which is I hate inefficiency. It just drives me absolutely crazy. I hate wasting food. I hate wasting time. And I definitely hate wasting money. I know I'm not the only one wired this way. I think a lot of dads in the room probably are. In fact, I saw this online, and I just figured I had to share it with you guys. This is dads after you move out and finally stop leaving the darn bathroom light on. Anybody else walk around turning off lights in the house? I know I'm not the only one. But I think what I'll suggest to you tonight is, while we should do that, let's not waste energy. I think as we think about our giving and how to give, the darn bathroom light really comes down to fees and taxes that you didn't need to spend money on. And we can probably have way more impact getting this right than we can walking around the house turning off the lights. So I think this is worth paying attention to. But one more thing that most pastors, nothing that you're about to hear. This is going to be way more tax talk tonight than anything you're typically going to hear in a sermon. But I had to ask myself, why is it that most churches don't talk about this stuff? And I think it comes down to this. Ultimately, giving in any way is better than not giving at all, right? So keep that headline message in mind as we go through this, right? If I tell you I'm not particularly fond of your favorite way to give, it's still better to give inefficiently than not give at all. And the other kind of thing I wanted to quickly kind of address at the beginning here is, I think sometimes, kind of certain types of thoughts get spiraling and, people start talking about tax efficient giving, and there's all of a sudden this kind of like, this is how the rich get richer. And I just wanted to point out that we're talking about giving money away, right? If your goal was to just maximize your own bank account, you just wouldn't give it away, right? And so even if you do some of these things smartly, what it means is the IRS is subsidizing your donations, but you still have less money than you did before, right? So let's not lose sight of that. In week 1, I criticized the prosperity gospel, and we talked about we don't give money in expectation that we somehow end up richer, right? I think we'll end up richer spiritually, but our bank accounts will probably have a lower dollar amount in them. Okay, we're going to get fun. All right, I told you we're going to have to talk a little bit about taxes as we go through this. Are you guys ready? This is definitely not a tax seminar, but given the topic and given that we're in March of 2026, there are some new things that relate to charitable giving that went into effect this year that maybe not everybody's aware of. So I just wanted to give a quick nod to this. So thing number 1 that I've got up on the screen here, it used to be the case that anybody that was going to get essentially tax benefit from making charitable donations needed to be itemizing their deductions. But one thing that's new for this year is that even people taking the standard deduction can get a little bit of a tax break, $1,000 if you're single, $2,000 if you're married, for making cash gifts to eligible charities. That's new this year, brand new, never been around before. The second thing that I was going to point out is you guys may have heard this, for seniors over 65, Eastman, I'm going to have to come to Joyfully 60 to talk about this, right? Joyfully 65 or older in this case, right? So there's a new extra kind of $6,000 bonus per person that gets added to that standard deduction. While that doesn't directly impact charitable giving, it indirectly does, right? Because it changes the calculus for folks on should I take that standard or should I take that itemized deduction. So those are some positives. There's a couple that work against you starting this year. So it used to be the case that every dollar that you donated to a qualified charity could be used as a deduction. It's now the case that the first 0.5% of your AGI doesn't count, okay? So if you're a household that makes $200,000, 0.5% is $1,000. So if you donate $20,000, you don't get to deduct a full 20 anymore, you only get 19. So that's new. And then the last one I won't spend a lot of time on, but if you're in the top federal tax bracket, instead of getting 37 cents on the dollar benefit, it's capped at 35. So again, not a tax seminar, but there's some new things this year that impact our charitable giving, so I did want to mention those. Okay, so we're going to go through a couple tactical ways to give, and I'll give you my thoughts on them. This is where the handout is going to be helpful. So again, if you missed it on the way in, grab it. I'll be referring to it. I'm not going to claim this is perfectly exhaustive, but I do think it's pretty comprehensive. And so it might be helpful. What I did on this was I kind of scored the different strategies on a number of different factors, as well as gave kind of an overall assessment. I just have to say it, I kind of did it in the disclaimer, personal finance is personal, right? Like everybody's situation is different. A strategy that makes sense for me might not make any sense for you. So I'm going to try to generally educate tonight, but again, it really does need kind of an individual assessment. All right, we'll start ticking through a couple of these. The first ones that I wanted to talk about was the online portal that's available to us here at Redeemer to give through. And this is context, here at Redeemer, but all charities, basically, you could apply some of this thought process to. I'll be blunt, I'll be direct. I don't particularly like it. There's a lot of bathroom lights on with this type of strategy, right? So the punchline is all about fees here, right? So when you give on your credit card, Redeemer has to pay a 3% transaction fee on every dollar that you give. So there's just change falling out of your pocket as you walk through the sanctuary, and it drives the inefficiency in me crazy. Credit card's the worst. You're paying 3% there. Maybe you're thinking about this and you link your bank account, you do it via ACH during on the same PushPay platform. There's a 1% fee on all of that. And this is material. I'll tell you this in a couple different ways. And Sam, I worked the math. I could figure this out. 30% of total donations to Redeemer are on a credit card or a debit card. So this is like a significant portion of the money coming in. And we paid, as a church, $36,000 last year. We're just lost to transaction fees. I looked up the price of a Bible on Amazon, almost 8,000 Bibles we could have bought for different mission organizations if we just gave smarter and didn't have the bathroom lights on and losing money to transaction fees. Someone in here is going to say, but Andy, I really want my credit card points. Who likes credit card points? I like credit card points too, right? But I don't want to give $100 to the church, lose $3 and get $2 back, right? If we're losing $3 and getting $2, it just doesn't make sense. Like if it's important for you to end up with $98 instead of $100, just give $98 instead, right? I mean, there's smarter ways to do this, I would contend. Okay, so that's the online portal. We got a story here about some higher fees. Let's talk about others that are kind of in this realm. We could just do cash paper donations, right? We don't pass the plate here on Sunday mornings, but we do have receptacles in the back, right? There's no fees associated with that, so we're good there. Fun fact, this is only 2% or so of church donations, so this one's not huge. I don't love this just for the simple, two reasons. One, you can't automate it, right? And it tends to lend itself to tipping, not tithing, right? We talked about like this shouldn't just be like, I heard a good sermon today, I'll kick some in, right? We want to have an intentional tithing strategy, so you can't automate it. And then the second thing here is you don't get any sort of documentation or receipt, for lack of a better term, from the church, which you will need if you want to get any of those tax benefits that I mentioned earlier. And then the second and third strategies here are, we go real old school, right? I mean, I like technology as much as the next person, but if you just write a manual check, believe it or not, that's actually not the worst way to give to the church, right? And so, again, my only qualm with this one would be it's not automated, right? You're just trying to remember to do it, but there's no transaction fees, no money's getting lost. The way we could potentially make that a little better, though, is most people have access to a bill pay system through their bank. So if you go to your bank and you can set up automation through that, right? And they'll sometimes even ACH the money to the church. Worst case, they'll send a check. In most cases, no fees to anybody, and you can automate it, and you get the receipts for taxes. So believe it or not, while there's a lot more flashy, sexy tech out there, those are actually some decent approaches if some of the more complicated stuff that we're about to talk to doesn't apply. All right, so if we're on our sheet, follow with me now. Now we're going to jump to number 6, donating stock. You've probably heard people say before that, a headline message that donating stock can be tax efficient, but I know a lot of people have maybe heard that statement, but they don't really understand why. So I just wanted to take a quick minute to give you guys the background of why this is the case, and then you can think about if it might apply to you. So the basic premise is this. When you buy stock in a taxable brokerage account, so we're not talking about IRAs or 401ks or 529s, just kind of a run-of-the-mill taxable brokerage account. Let's say you bought that stock at $100, you held it for 20 years, and now it's worth $500. If you want to sell it and spend it on tickets or whatever it is you want to do with that money, that $400 gain, you have to pay capital gains taxes on. But the IRS has this very generous provision that says if you give that stock to the church or to a qualified charity, they can sell it and they don't have to pay any tax. So that's the magic mechanism here, right? So I put a little bit of an example together here. Again, won't go too far into the math, but let's say your goal, and you're this person, your goal was to give $10,000 to the church. If you were to say, I have a bunch of stock and sell it, in this case, in the example that I drew up, you'd have to sell about $11,300 worth of stock. $1,300 would go to the tax man. That would leave you with $10,000 to give to the church. But now that you've heard this and you understand this, you're just going to say, instead of taking $11,300 worth of stock, I can just take $10,000 and give it to the church, achieve the exact same outcome, and we have less bathroom lights on, right? So in this example, we saved 11%, right? 11% that would have otherwise gone to the IRS. Now we don't have that leakage. This could be concocted a lot of different ways. It's going to be more valuable when two things happen. When you look at your securities, let's see if I can get this laser pointer working. The larger the gain is, the more impactful this strategy is, right? If you only have a small amount of gain, this isn't worth that much. But for things that you've held a long time that have appreciated, maybe you got onto the NVIDIA thing early, right? This is a powerful strategy. And then the other one is your particular long-term capital gains tax rate, right? The larger the tax rate you would have to pay, it's even better to make sure that no one's paying that, right? So those two dimensions are the important ones to think about here. I'm going to skip that. All right. So let's talk about like when would be a common situation for this strategy to be helpful. So the first and most obvious one is, let's say you were thinking about selling that stock anyway. Great, right? Like that's the easy one. You already wanted to get rid of it. So instead of you selling it, right? And I'm thinking primarily about a situation where maybe you're working, right? You've got income coming in. So instead of giving the income to the church, give the stock to the church, and then use the income to reinvest, right? That's kind of what we're talking about here. So if you're planning to sell it anyway, that's an easy one. Maybe you came out of last week's discussion and you realized, owning the whole market makes a lot of sense. I want to be diversified, but I've got these positions of individual stocks or concentrated investments, and I'd really rather get out of them, but I have huge gains. If I were to sell them, I'd have all these taxes. Problem solved. Those are great things to give away to charity. Maybe you heard what we talked about last week and you're like, I like the idea of low-cost index funds, right? I can save on my fees, but I've got some high-cost funds that have a lot of gains, right? Again, give those to the church, use your cash to rebuy the things that you would rebuy today. The only other two I wanted to call out here are, we talked about tip number 8, I think it was, in last week. I said buy, hold, and rebalance, right? And we talked about the discipline that it takes to, if you're trying to maintain a 60-40 portfolio and the market surges and everybody else is like, now's the time to buy, you now have the discipline to say, nope, I'm going to do my 60-40 portfolio, and now I need to sell. But you're like, if I sell, I'm going to trigger these taxes. Enter giving the stock away, right? So this is a good way to rebalance towards your objective without triggering taxes. And then here's the one that a lot of people miss, which is, let's say you're like, none of those apply to me, Andy. I actually like the investment that I have today. Great. This strategy can still make sense, right? Because if we go back to our picture, if you have a share that looks like that graph on the left and there's this big old gain, right? Give that one away and just rebuy the same thing, right? Because now you've reset the price that you bought it at a much higher amount. 2 years from now, when you want to sell, you'll have a smaller gain that you have to pay tax on. So giving appreciated stock, appreciated securities can be a hugely tax-efficient way to give to the kingdom of God. I am not going to go through all of these reminders, but I just wanted to put these on the screen briefly to tell you that when you're doing this, there's a number of rules that you need to keep in mind and wires you want to make sure you don't trip. So make sure to research it or work with somebody that kind of knows the things to look out for. Make sense? Okay. So now hopefully I got you there, and maybe you've got a taxable brokerage account, maybe you've got appreciated stock, and you're like, that sounds great, but that sounds like a royal pain to do with all the different missionaries or charities. Like maybe it makes sense for the church, I give most of my money there, but I don't want to do it for the $100 donation that I want to give to such and such a cause. Okay, so to solve that problem, we're going to introduce the idea of a donor-advised fund. Has anybody here heard of a donor-advised fund? A few. Okay. So here's basically how this works. So a donor-advised fund essentially acts as a middleman entity between you and the ultimate charities that you want to support. So the basic premise here is, here's our donors over here. They like this idea of giving appreciated securities, or it could be a lot of different things. These donor-advised funds are really sophisticated entities. They're really good at handling donations from that are kind of more complex, that your kind of run-of-the-mill charity might not have the administrative staff to be able to handle, right? So these guys are experts at it. So you give the money to them. They are themselves a charity, right? So we'll come back to this. This is an important point. And it's no longer your money when you do this, by the way, right? Like once you do this, if all of a sudden, tomorrow you're like, shoot, actually I want that money back so I can, too bad, it's gone, right? Like you can tell them where to send it to other charities, but you can't get it back for you, right? The IRS, by the way, only cares about this step. This is when the donation happens, right? Because like it is no longer your money at that point. So you get it into this donor advised fund. This is now like a centralized online giving hub, right? So I can log into my online account with my donor advised fund and tell it, okay, now I want you to distribute X dollars to the church, Y dollars to the food pantry, maybe my university should get some. My kid just came out, this happened to me real story. My daughter came out of a church event one time and said, hey, we just learned about this organization that's standing up portable showers in Hawaii, and we want to help them out, right? And so I was like, okay, we'll give them $50, right? There's no way in the world I would have been like, I'm going to call them and try to give them a share of stock, right? It would have been too complicated, right? But with the donor advised fund, I just click a couple buttons and boom, a $50 check goes to portable showers in Hawaii. So there's a lot to like about donor advised funds. Like you're not chasing a bunch of different receipts at the end of the year. You get one charitable donation receipt at the end from the donor advised fund. You can give complicated assets and they're equipped to handle it. The other thing that's nice is you could give like one big chunk of stock at the beginning of the year and then tell them to kind of parcel it out in smaller amounts to the charities throughout the year. You can automate it, so you can say, okay, now that I've funded the donor advised fund, automate X dollars every month to Redeemer Missions, Y dollars every month should go to Redeemer, and I'm going to tag it for my tithe, like whatever it is, like you can kind of automate it. You can give the appreciated securities, and there's no fees for the church. Did I mention that? The bathroom lights are turned off here, right? And so, and most of these guys can even work with the office to set up ACH transfers, so it just like shows up in the church's bank account. Like you don't have to deal with it, they don't have to deal with it. It basically just happens. So I really like donor advised funds for a lot of these reasons. And there's more benefits that I don't have time to get into today, but hopefully that gives you a flavor for it. So what's like, we got a question. Go for it.
What's in it for the DAF?
Yeah, good question. I mean, so there are some fees that you would have to pay. But watch out for them. They're not all the same, right? And so some of them charge like 1% of whatever's sitting in your account, but you can get it lower. Like the one that I use charges 0.6%, which is still more than I would like, right? But if the tax benefits are enough to overcompensate that fee that you'd have to pay, it would still make sense, right? So again, like you don't want to do it like blindly, but you can, if you find enough tax savings, there's ways to like make that work. And in a lot of cases, it can still be worth it. Good question. Okay. Oh, whoops, I didn't talk about this one. Okay, so here's the like simplest example, right? Like if your objective was mostly, I want to use the donor advised fund, I want to give appreciated securities, this is what I'm going to call the single year approach. I start the year with basically no money in the donor advised fund. I put money into it. Let's say I put $15,000 into it, and then I tell it throughout the year to give that $15,000 to the charities that I want to support. So then I end the year also back with $0 in my fund. So the benefits of this are we're giving appreciated securities, we've simplified it, we have this online digital hub, so all the things we just talked about are good. But here's where there might still be more juice for you to squeeze. So one thing that a lot of people don't realize is like there's this kind of notion, oh, charitable giving lowers my taxes, right? Like people have this intuitive sense, a lot of Americans do. But in fact, for most people, charitable giving is not lowering their taxes. And let me explain why. So we talked about this earlier. Again, put the new wrinkle aside that's new in 2026. But for most of the history that we're familiar with, right? If you wanted to reduce your taxable income through your charitable giving, you had to itemize your deductions, right? So again, remember tip number 9 last week was it pays to learn the basics of how the U.S. tax system works. This is where these things start to come into play. So when everybody files their taxes, right, you get to pick between, do I take the standard deduction or do I take the itemized deduction? Both of these things will have the effect of lowering your taxable income. So you want to take whichever one is largest, right? Make sense? So up until 2017, 2018, that standard deduction for a couple that was married filing jointly was something like $12,000 a year. So it was, relatively speaking, easier to clear that with charitable giving and other things and say, okay, I'm going to itemize and therefore get a reduction in my taxable income. But then with the Tax Cuts and Job Act that happened in 2017, 2018, the standard deduction jumped significantly, right? So the hurdle rate that you would now have to clear to make it make sense to itemize is all of a sudden a lot higher. So here's why I made the comment I did earlier. Only 10% of filers in the US itemize deductions anymore, right? So for the other 90%, giving to charity really doesn't change their tax situation much at all. You could still do the appreciated security thing and avoid having to pay those gains, but it's not further reducing your taxable income. So imagine this household that I have on the right here. So they have $8,000 worth of property taxes. They've got $10,000 of mortgage interest, which is deductible. Now we've got this new thing in 2026. So they gave $15,000. They had to carve off the first 0.5%. So they were able to deduct an additional $14,000 of their charitable giving. And so they added up, like, if I itemize, I could get to $32,000. But then they looked and they were like, oh, the standard deduction is actually a couple $100 more than that. So they would say they would take which one? They would take the standard, right? And so then, this couple looks at their return and they're like, well, we gave away $15,000. My neighbor, let's just imagine, fictitious world, clone, everything else is the same, but they didn't give away anything. They're not as crazy as us Christians to give away this 10%. They gave away nothing, and we took the same deduction, right? So basically what we're saying is for this household, their charitable giving is really not making any impact on their taxes. How do we solve this? Potentially, again, with the donor advised fund through what we might call a bunching strategy. So don't get scared off. I think I can get you this in a pretty straightforward way. This is how this would work, right? So instead of giving $15,000 this year and $15,000 next year, what this couple's going to do is front load it all into year one, right? So they're going to say, we're going to put $30,000 into the donor advised fund in year one. Now, this might be $15,000 on January 15th, and then you do the second $15,000 like right at the end of the year, right? But we're going to squeeze that in so that in year one, you'll see this on the next slide, it's going to tip us over into itemizing in year one. But just to make sure that we don't want any impact on the charities, right? We're trying to play a few tax games here, but we want to make sure our charities are getting what they want. The donor advised fund, the benefit of it, remember, is what the IRS cares about is this first piece. When did the money go from you to a charity? The donor advised fund is a charity, right? So that's what they care about. But you can then still decide when to give it out to the ultimate end charities you want to support, right? So maybe I put $30,000 in year one, and then 15 of it I give out to the charities that year, and then I save the other 15 to give out to the charities in year two. So if you're a church, if you're any other organization, you have no idea that this other stuff is happening before it gets to you. Like, there's no difference in the world from your perspective. But what happens for this household's taxes? So like, in the more straightforward path, right, they did the math every year and they're like, I guess I'll take the standard, right? And so over a 2-year period, this couple deducted about $64,000. But now they wisened up, they bunched their donations, they're given appreciated securities, they're using the donor advised fund, and that gave them a situation where in year one, all of a sudden it makes sense to itemize. They were able to itemize and deduct $47,000, still take the standard in year two, so over a 2-year period, instead of getting $64,000 that shielded their income, they're instead deducting $79,000. So with their tax rate, this saves them somewhere between $3,000 and $4,000. That's a lot of bathroom lights on, right? Like, just because we're putting some of these tools to use, all of a sudden, if I could tell you have $3,000 to $4,000 that you can go spend on whatever you want, or give more money to the kingdom, right? Like, these are good things. Does that sort of make sense? All right, and this one is fun because you're putting a lot of these strategies together, right? You've got the appreciated securities, you've got the donor advised fund, you've got the bunching, you've proven that you understand the tax code, right? So there's a lot to like here. Last thing on this is, if you want to get even more fancy, like that would all work in kind of normal steady state world, but there are life moments where this is really extra powerful, right? So remember, you get the taxable donation in the year you donate it, right? So in my example that we just went through, that was year 1, right? So look out in your life for situations where you're like, this year I know I'm in a higher tax bracket than I'm going to be in next year. Because if I'm in a higher bracket this year, it's more advantageous to give when? This year, right? So maybe you're about to retire, right? You know you're in a higher bracket now. Next year, you're going to be in a lower one. Maybe you're selling your business this year. Maybe you're doing a larger Roth conversion this year. Maybe you're in sales and you know you're getting a big bonus this year that's going to push you into a higher tax bracket. You're working at a company where you're going to get a big vesting of restricted stock units, right? Maybe you're getting an inheritance this year. There's a number of different situations where this can play out. So now that you know these tricks, right, you can think about, again, how can I kind of front load or kind of marry up when I'm in that high tax bracket situation, give to the donor advised fund, and then I can give out of that to the charities for years to come. So it doesn't make it, like it used to be the case without a donor advised fund where you'd be like, well, yeah, I could give the church a bunch of money this year, but then I don't like the fact that I'm not giving anything for the next 3 years. But that's not our concern, right? Because you can kind of still pace it to the charities the way that you want. Make sense? Did I lose anybody? Half of you? We're good? All right. I only have 2 more. We're almost there. You guys are doing great. So the next one that I wanted to talk about was a qualified charitable distribution. So this will be a big one for our joyfully 60, no, we're going to have to go 70s on this, Eastman. Do we have a name for that group? Plus. Okay, this is the plus, right? Okay, so if you're over 70 and a half, this one potentially has your name on it. So if you're over 70 and a half and you have money in a traditional IRA, which a lot of people do, so I think this is a pretty accessible strategy. So here's the magic with this one. You put money into the traditional IRA tax-free, right? It was pre-tax money that went in. It was tax deferred as you invested it, so you didn't have to pay taxes until now when you want the money, right? If you take the money out at this point, you have to pay ordinary income taxes on it, right? But you can instead say, actually, don't send the check to me. Send it to Redeemer or the charity of your choice. And what happens is that amount basically comes out before taxes or your taxable income's figured out. So it went in tax-free, it grew tax-deferred, and then it came out tax-free if you do it this way, right? Like completely bypasses everything. So that's good. If you're a few years older than 70 and a half, it's either 73 or 75, depending on your birth year, and you're in a situation where you have to take required minimum distributions, which trigger taxes, right? You could say, this satisfies your RMDs, so that's good. The other thing is you can do this and still take the standard deduction with a little bit of like double dipping there. This gets around that whole 0.5% AGI floor that we talked about. And then the other thing, for those of you on Medicare, you know that your AGI dictates your IRMA premiums, right? And so by doing this, you keep your adjusted gross income lower versus if you took the money yourself, which can keep your Medicare premiums down. So I know that was quick, but I think qualified charitable distributions are a really powerful tool for folks that are over 70 and have traditional IRA assets. Again, not going to do this in this forum, but there's a number of things you have to keep in mind to kind of deploy this strategy effectively. So make sure you kind of do your homework there. All right, I got one more for you. You guys ready? Let's say this, everything up, we're going to have to get a little bit morbid here, okay? But remember, it's Lent, and we had to recognize in the last few weeks that to dust we shall return, right? Like, that's part of this game. And so while these other strategies kind of help optimize while we're alive, now let's think about one as we think about legacy as we approach the end of our life. So let's say you're a household and you have, your assets for simplicity are in 2 buckets. You've got your taxable brokerage account with a bunch of these appreciated securities that we talked about earlier, and then you have a traditional IRA, which is the one we were thinking about for QCDs a second ago. So I've shaded in pink here. This, like while you're living, the gain, right, that we talked about, that is kind of like a tax risk for you. And then that whole traditional IRA, remember, like you haven't paid taxes on that yet, right? So if you don't give it away in a QCD, if you pull it out to spend the money, you're going to have to pay taxes on that too. Okay, so let's kind of think forward to the end of life. Like, what could we do with that? This would be the inefficient way to approach this. If you said, okay, church or charity, whatever, whoever you're going to give it to, whatever charitable organization, you take the taxable brokerage assets, and I'll give my kids what's in the traditional IRA. This is inefficient, right? Because the church isn't going to have to pay any taxes, so they're good, but your kids have to pay tax on everything that they get from that traditional IRA, right? So that doesn't feel great for them, especially the way a lot of the timing works on these things is if everybody's living kind of the typical ages, a lot of times your kids are getting that in their peak earning years when they're in their highest tax brackets they'll ever be in their life, and now all of a sudden this throws them into an even higher tax bracket, which I'm sure they're happy to get the money, but again, a lot of bathroom lights are on here, right? Okay, so what should we do? If we flip those things, this picture gets a lot better, right? So there's a rule in the tax code that says within taxable accounts, we bought that stock at 100, it grew to 500. When you die, the IRS basically says, don't worry about the gain. We'll just pretend it is basically you bought it at the value it is right now. They call this a step up in basis. So if you give those funds to your kids, they get them. They don't have to pay anything in taxes. The traditional IRA, if it went to the kids would have to pay taxes. But again, churches and charitable organizations are different. If you pivot and send that to the church, they don't have to pay tax on that, right? So the bottom strategy here gets us in a world where no one has to pay tax on any of the assets that we're talking about. So the punchline here, and again, everybody's situation is different, but you want to be thoughtful about giving the right assets to the right recipients. Okay, we got through it. You guys did great. We have a couple minutes, so we're going to do something. I want to get back into small groups, if you guys could. Get back with the group that you were talking about earlier. And I'm just going to pose at the end of our 3 weeks together 2 questions. Did this series cause you to think about anything differently than you did before? And more practically, what's one way in any of our 7 buckets in the framework that you think maybe you could steward the resources God's entrusted you with a little bit better or differently than how you were thinking about it before? So take a couple minutes, talk about that with your friends next to you, and then we'll wrap it up. All right, excellent. Okay, let's bring it back together. We're going to wrap up here shortly, but before we do, Sam's going to run around with a mic. So I don't know if any group wants to either share one of the kind of major nuggets coming out of your conversation, or if anybody has a question, I'm happy to see what I can answer here live. We've got 3 to 4 minutes, and for anything we don't get to, you can feel free to send me an email. Happy to chat. But yeah, great.
Great discussion. Awesome. Can you give us maybe a quick shot description of the benefits of insurance? Because life insurance and things like that, I notice.
Yeah, good question. Yeah, we talked a little bit about this in my tip 10 from last week. So check out I think it's all on YouTube, Sam. So that's a good place to start. Absolutely. Here's the thing about insurance. It, again, fits into that nice bucket of personal finance is personal. So I mentioned quickly last week that there's some people in this room that probably don't have life insurance and should. I'm a big fan, if you're going to do life insurance and you need it, term life insurance, right? It's cheap, it's affordable, it protects the death that you're worried about. Take the lower premiums there and invest in the market. Don't do a lot of the whole life, things like that. But it's personal, right? I mean, I mentioned last week I worked with a client who had 2 young kids, and neither him or his wife had life insurance, and they probably needed it, right? There's other people that are older, they're retired, their kids are grown up, and they're still paying for life insurance that they probably don't need, right? And so, there's no one uniform answer there, but the basic premise as I think about insurance is insure against the big, massive risks in your life that would be catastrophic to you and your family if they should occur, right? So the big ones there are typically life, home. A big one that a lot of people miss is disability, right? If you're early in your career and you're relying on your future earnings, what if you get disabled and you can't earn any money anymore, right? So that's sometimes one to think about. Umbrella insurance can be important to kind of prevent against getting sued for $5 million, right? That would have a pretty big impact on a lot of people. If it's smaller, I would say self-insure, right? So I was talking to somebody the other day, and they were telling me how proud they were of the basic insurance policy they had on their cell phone. I was like, yeah, but like, you're probably able to just buy a new cell phone, like if that happens, right? Every insurance policy you buy, you should expect to lose money on it, right? Because the insurance companies have to, what they pay back to people for losses is only a portion of what they collect in, right? So that tells you that on average, you're gonna lose money, but you still want it for the situations that would be massive for your loss, right? So insure the big things, don't insure the small things is kind of the high level message there. We have time for one more, Sam. Comment or question. Either way is fine.
Just real quick, I never knew that there was a fee that the church paid. If we do it on the app, or I never knew that. I guess it makes sense, though, doesn't it? Everybody gets their cut. You know,
It does. It does.
Well, I guess I know what we're going to do now.
We got to turn those bathroom lights. It's great that you say that. I was talking to somebody a couple years ago on this same topic, and he had the same reaction. He's like, I've always given on a credit card. And he's like, but I should have known better. I'm a small business owner, and I know how much I have to pay in credit card transaction fees, right? So it's great to keep an eye on that. Again, some of these things are great. Appreciated stock, donors advised funds, but honestly, just writing a check is a pretty efficient way to do it as well. Excellent. Well, before I hand back to Sam, I just wanted to say, thanks, Sam, Sean, Austin. I'm glad that we're at a church that was willing to carve out the space and time to talk about wisdom and financial matters, and specifically, because my experience is there's people that are willing to talk about theology, there's people that are willing to talk about money, but sometimes you don't get a chance to do both at the same time, and so I always enjoy doing that. I've enjoyed doing this. I hope you guys have gotten at least something out of it. My email is on the handout today, so if you have anything that you want to ask or talk about, feel free to reach out. So, Sam, hand it to you.
Can we give it up for Andy? Andy, just want to reiterate how grateful I am for your willingness to do this. I know that you put in so much time, so much effort into doing this, and it is immensely valuable beyond anything that we could calculate. So thank you so much for your time and effort in this, and just pray that that would just be a blessing to our church. One of the things I learned specifically today, but throughout this whole process, is how grateful I am for people like Andy who understand this stuff. Because I come from a finance background. I was able to understand a little bit of it, and then you started getting into things that it was like, I don't even know what's going on anymore. So I'm so grateful that you have the knowledge and the wisdom, and that you're willing to share it with us, but you bring it down to a really approachable level. So definitely more confused. No, I'm just grateful for your willingness to teach this to us in a way that's understandable. So thank you for your time and your effort with that, Andy. He has a QR code up on the screen, so and like he said, his email is on those handouts. So and he'll be around afterwards as well. So if you have questions, you can come ask those to him. I know that it's on his heart. He would love to talk with you and share wisdom with you. Just a reminder that we have some refreshments out there. We've got some sparkling water. We've got fruit for our fasting Lent observers, and then we've got chips for all of our heathens and pagans. All right, so we got both out there. We got some coffee as well. So feel free to hang out, fellowship, come ask Andy some questions, and then just a reminder. If you want to know about anything that we have going on here at midweek, go ahead and scan that QR code, sign up for our email list. We've got those handouts at the back as well that have QR codes for our pastor Q&A that's coming up in a couple of weeks. So be sure to scan that, submit some good questions, and then as well as a Holy Week QR code. We have a lot of things going on here at the church during Holy Week, and we want you to know about them. So be sure to scan that QR code on your way out as well. Would you please stand, and then Eastman, would you join me up here to speak a blessing over us?
Thanks, Sam. Andy, thank you. I'm sitting here listening to my wife going, Let me pronounce God's blessings on you. So just, good. Just take it, okay? The Lord bless you and keep you. The Lord make his face to shine upon you and be gracious unto you. The Lord lift up his countenance upon you and give you peace. Now go in peace to love and serve the Lord. Amen.